Good morning. Today is July 24th, and we are late a couple of minutes, but we will do some presentation today for the project. And once we're done with the presentation, we will proceed with chapter 21, and we go from there. Now, Brother Grimm is here, and he is ready to. You have your flash drive? Okay, you can put your flash drive there on the computer from the other side, and okay, let's see. As soon as it comes out, we will open it. Okay, what does that mean? Device scanning, notification, software installed successfully. And do you want to scan this device?
No.
No?
You go to the folder.
Okay, and go to the folder here and open folder. Go ahead and finish it. Just give it a couple of minutes. I saw Mr. Darian, Reverend Darian is coming.
Yes, sir.
On his way. Okay. Good morning, good morning.
Oh, that presentation today?
Huh?
Presentation today?
Test?
Nothing, presentation.
Yeah, we remember.
Oh, it's
Yesterday you said.
I got 14, 15,000 gonna turn them all into your ones.
Sure, I'll take them when it's done.
Yeah, I'm talking about like at the end, I was gonna, instead of just turning them one by one, I'm gonna turn them all in at once.
No, one by one, but make sure that you log in and you submit it.
Okay.
Yeah, it doesn't look like you submitted all of them.
It is?
You
Okay.
submitted one or two.
Okay.
No. Go ahead.
Good morning, class.
Good morning,
I'm
sir.
Larry Grimm, and today for my racial analysis project, I'll be presenting Walmart. Walmart Incorporation is an American multinational retail corporation that operates a chain of hypermarkets, discount department stores, and grocery stores. Headquartered in Bentonville, Arkansas, the company was founded by Sam Walton in 1962 and incorporated on October 31st, 1969. It also owns and operates Sam Club Retail Warehouse. As of January 31st, 2018, Walmart has 11,718 stores and clubs in 28 countries, operating under 59 different names.
Oops.
I'm about to name a few of them. The company operates under the name Walmart in the United States and Canada, as Walmart de Mexico, Central America, in Mexico and Central America, and in the United Kingdom as Asda, as Suya Group in Japan, and as the Best Price in India.
Nothing. Oh, in India.
Yes, sir.
Any in the Middle East?
Yes, sir.
Do they have any in the Middle East?
Hold on, let me get that. It has wholly owned operations in Argentina, Chile, Brazil, and Canada, Walmart Incorporated. So no, there's not any in the
Nothing in the Middle East.
Yes, sir.
Okay.
The closest you know is ended. That's about it. And American multinational. Oh yeah, that's it. Let me see. My liquidity analysis. Liquidity is defined as a measure of extent to which a person or organization has cash to meet immediate and short-term obligations or assets that can be quickly converted to this. The current ratio is defined as the indicator of a firm's ability to meet short-term financial obligations. It is the ratio of current assets to current liabilities. Though every industry has its range of acceptable current ratios, a ratio of 2 to 1 is considered good. Okay, and my current ratio was 59 million over 78 million, and then that equals 0.76. And later,
59 billion.
Well, yeah, billion, my fault.
64 million.
Yeah, and later I'm gonna shorten it to look like this, like how these look, and they
that's the
still
quick
represent.
ratio?
It still represent a billion. Okay, so my quick ratio is defined as an indicator of a company's short-term liquidity and measures the company's ability to meet short-term obligation assets. And this, because we're only concerned with the most liquid assets, the ratio includes inventories for current assets. My quick ratio was 59,006,400 minus 43,783,000, and that's divided by 78,527, and my percentage was 20 cents. And then my company does not have a good liquidity to meet the short-term needs, because I feel it should be higher than that.
Yeah, should be 1 and above. Yeah.
Yes, sir.
Okay.
Oh yeah, and then the liquid. Remember, we have to add the return on inventory and all that, and then the net sales equals accounts receivable, and then mine was 495,000. Well, million divided by 5,614, and I got 88.
Is that interest coverage ratio?
Yes, sir.
Okay.
And then the coverage ratio is the cost of goods sold divided by the inventory.
It's inventory turnover.
Inventory turnover.
Yeah.
And then mine was 396 million over 43,783,000.
Is the first one 88 or 0.88?
No, I got 88 because this 5,000.
Okay.
Yeah, it gave me a whole number.
Okay.
Yes, sir. Profitability ratios. Profitability is defined as the ability of the generous to generate revenue, and my profit margin ratio is defined as the profit margin ratio, also called the return on sales ratio or gross profit ratio, is a profitability ratio that measures the amount of net income earned for each dollar of sales generated by comparing the net income and net sales of a company. My PMR equals 2,523 divided by 4,995, 761, and my percentage was 0.02.
Okay.
And then return on assets ratio is defined as a financial ratio that shows the percentage of profit a company earns in relation to its overall resources. And my ratio was 10,523 divided by 2,004,522.
You're supposed to do yours.
And
bring
mine.
it back to me. You haven't brought it back to me yet.
I haven't.
Yeah?
You want me to print this out? Or email it?
Yeah, you can email it to me.
Okay.
Once we're done. Yeah.
And my percentage was 0.05. Then return on equity ratio is defined as a profitability ratio that measures the ability of a firm to generate profits from its shareholders' investments in the company. In other words, the return on equity ratio shows how much profit each dollar of common stockholder equity generates. And this is what I got for my return on equity ratio: 10,523 divided by 80,822, and I got 0.13.
That's the interest coverage ratio.
Yes, sir.
Okay.
And then according to my profitability ratios, my company is doing well when generating revenue or profit. Long-term solvency is defined as the company's ability to meet its long-term obligations when they fall due. Debt to equity ratio is a ratio used to find a company's financial leverage. And then my debt to equity ratio is 123,700 divided by 80,822, and I got 1.53.
Do you have more debt or equity here?
More debt, kind of, sort of, I want to say. My interest coverage ratio is a measure of a company's ability to meet its interest payments. And then the ICR equals 15,000 123 plus 2,178 divided by 2,178, and I got 7.9. And then in the long run, my company will be able to continue its rise unto the top because our long-term solvency is solid. Market strength ratio. Market strength ratio is used to evaluate the current share price of a publicly held company's stock, which help determines if the shares are over or underpriced. My price earning ratio is defined as it shows the sum of the money you are ready to pay for each rupee worth of earnings of the company. And then this is my price earning ratio, and it equals $86.90 divided by $3.29, and I got $26.41. My company market strength is strong enough to stay afloat in the current economy. And in my conclusion, Walmart current market value per share is $86.90. Walmart's overall state of business is good and still vastly growing in many countries. And I would recommend people to invest in Walmart because every stock you invest in, you receive $3.29 per share, which is great in my books.
Okay.
And that's
I wish you wrote down the formulas in addition to the number.
Yes, sir.
Yeah. So you might want to go back and write the formulas for me before you email it. Yeah.
Okay.
Just write the formula
Yes, sir.
in not just in numbers.
All right.
Okay. Yeah.
Yes, sir.
So very good.
So,
Go ahead.
so Larry, it's a great project, I must say. Well, I've got one quick question, okay? So, when did you guys start? How did Walmart become this multimedia company?
See what happened was I watched the documentary on Walmart.
Okay.
See, they started with one store.
Okay.
They were smart, right?
Yes,
And then bam, they started getting that pull, and he noticed that instead of me just doing this one small store, I could go big and go retail, and then have plenty of stores. And he started branching off doing. See, then it just started like how we see Walmart now. It didn't start like that. It started as a little small grocery store, and then he branched out to one. He started making money.
Like Bricks.
Yeah, basically like groceries.
Oh, okay.
I know you're not required to do that. Did you come through their marketing strategy?
Marketing strategy?
Yes.
No, sir. I ain't read on the marketing strategy. But I watched the documentary. But I didn't.
Any idea about their marketing? It's not going to count against you. I'm just wondering.
Like what you mean? Like a strategy? Just like one strategy I noticed?
Yeah, when they do their advertising and things like that.
Well, I feel like, you know how Amazon do when they have, like, they let you come and sell your products there, and then they see how your product's doing, and then they try to mimic your products at the same time while they sell theirs. And when you go to their store, you see their products first, and then you see everybody else's products, and that's how Walmart is. And I feel that's what they're gonna eventually start doing with the Great Value Van, with the Great Value brand. They're gonna have that up front first for you to see more instead of other brands. And I feel that's one of their market strategies. They see what brands doing good and what's selling the most, then they go and start theirs. Like say string beans, they got the Great Green Giant. Well, no, I'm gonna go spinach because they got, I can think about Popeye spinach and then the Great Green Giant, and then say they see that and then they go get their own Great Value spinach, and then they sell theirs cheaper and they put theirs first on the road before you.
Yeah, I see that. Yeah.
Yes,
Is a difference in the quality of the Great Value and the others?
it's cheaper. I
Yeah.
think everything else better.
In terms of the contents, in terms of the ingredients and
Yes,
things.
sir.
They're the same.
They'll use like from the current. I think they use the current like people in the town to buy these vegetables and stuff from. So So I feel they do the cheaper route instead of importing these stuff.
I wonder if you saw their how many distribution centers?
The Walmart have?
Yeah.
I want to say like 1,000 or more, maybe more than that. Let me go look it up real quick.
Do you know? You understand what I'm saying? Distribution center.
Yes, sir.
Yeah. No, you don't have to. It's all right. Well, I guess that's any other question.
No, I've already asked my question.
Okay, good. Well, not bad. You have good. I like it. Like
One more question.
Okay.
Mr.
Oh, he was doing talking about Walmart. Yeah.
Well, one question I would have is, what are y'all advertising?
Yes, I just
you
asked him
missed it.
same question. Yeah.
Oh,
I told them, like if you ever notice what they do is they let these other brands come and sell in Walmart, right? And they watch the other brands and see how they do, and then bam, next thing you know, Great Value have the same exact type of item they selling,
okay.
and it's cheaper now.
Walmart do the same thing.
It's more affordable.
No, because they have
sodas.
with the high rate of theft that Walmart experiences on a day-to-day basis. How does the company plan to improve that?
Well, you know, with the new technologies, we have the camera like right at the register, and then you have the camera at the end of the aisle, and at the beginning of the aisle, then you have the overhead cameras too. And then what you don't know, they got one on, they got a camera on each shelf.
Oh,
Yeah. So they really watching people now, and then they have like say like I could go in there dressed like this, but I'm working for Walmart. You don't even know. I'm
The
just
secret
looking-
shoppers.
Yeah, the secret shoppers.
Oh.
They have a lot of people that do that too.
Undercover.
Mm-hmm.
Okay.
So when you shopping and you feel like somebody watch you,
they are.
and you look around and ain't no Walmart person, just regular people, one of the people see the shoppers.
Secret shoppers basically like people trying to catch somebody steal.
Mm-hmm.
Okay, that's the A right there.
Go ahead and email me this one, but I do need the ones with the ratios.
They be buying so they just be looking.
Let me.
Just get paid to act like you buy.
Man, I know they gotta get.
Did you stop it?
Budget or something at Walmart. Here's like $200.
Oh snap! I am.
This one?
Yes, sir.
Okay, let me.
How long they been doing it?
I think it's free money.
They pay me 6 figures. I'll retire with them.
Nah, they ain't gonna pick up six.
No.
I'm just.
Well, no. It depends on which Walmart. Because if you go to the original one, they probably got the people.
Since you already.
The original anything.
Since you already logged in, go ahead and do your password and email that to me.
So Dr. Ali, how you doing this morning?
Huh?
How you doing this morning, Dr.?
Not well. I feel sleepy. I woke up around 1:30. I couldn't go back to sleep.
Ah, that sucks.
It's terrible.
Try and toss and never.
I gotta work tonight.
Can't wait till this thing is over.
Because I slept during the day.
Oh, that's why. You must have went to sleep when you went home, huh?
Them midday naps be better than nighttime sleep. I
Just
can't
H Ali.
Daytime sleep.
H Ali. H Ali.
Dot.
H no yeah, HALI at
I can't get those.
HALI at texascollege.edu.
When I get home at the glass here,
All right, and then attach, insert,
like next week.
and I go to insert attachments, and go to Lexar. Open.
And I got a date soon when I get home.
And put your name also for me. Okay. And send. No, you should have said no, because that's every time somebody will log in, then your username and password will.
Oh, it said that?
Usually, if you say yes
Oh,
or
I thought I exited out.
yeah, no. Sign out. Okay, it's all right. We good.
Check
You
my,
can yeah. Eject.
it was gonna say it's
Yeah.
still open.
Still in use. Get out of Outlook completely. No, it's good that your password is not there. Don't you close the presentation?
We'll just check it.
All right, thank you, and let's proceed with chapter 21. Now we have 2 more days for the class to be over. So today I'm going to give you guys the final.
Right, okay.
Yeah. Once we're done from here, I'll go and print one. And I do need the assignments.
Oh, yes, sir.
I do need the assignments. And today I will have chapter 21, but I will hand you a copy by the grace of God tomorrow. Yeah. Okay? Go to the chapter 21 on your textbook for a second. And look at exhibit 7 and exhibit 8 before we look at page 930. Page 930. Okay, look at those 2 exhibits 7 and 8. Do you see a difference in the income statement? Those 2, first look at these 2 here. One of them traditional income statement and the other is contribution margin income statement, exhibit 7. Do you see a difference between the 2?
Yeah.
What's the difference?
The operating expenses, variable.
Okay, so sales revenues minus cost of goods sold minus operating expenses and the contribution margin. See that? On the traditional, you see sales revenue minus cost of goods sold. Just the variable portion. Okay? Just the variable portion. And then minus cost of goods sold, the fixed portion. So and then that will give you gross margin. On the contribution margin, you will see sales revenues minus cost of goods sold, variable minus operating expenses. See, instead of gross margin, you will see contribution margin. Okay, and then minus cost of goods sold, the fixed, and minus operating expenses fixed. That will give you operating income. Okay, this is for this slide. I thought we look at this exhibit. Okay, before we get to once we like you see over there here a contribution margin income statement or a variable costing income statement. It emphasizes cost behavior rather than organizational function. That means you look when you say when it says cost behavior, we're talking about variable and fixed portion. Variable and fixed portion. As you can see in here, okay, the bottom section after minus operating expenses, after equal to contribution margin on the second portion of the exhibit 7. You see that? Yeah, you have contribution margin. The others you have traditionally will have gross margin. Okay, you have a gross margin, and then from a gross margin or gross profit, and then you minus your operating expenses, but they are divided into fixed and variable. Same thing on the contribution margin income statement, you won't see gross profit or gross margin, you see contribution margin, okay, and then minus cost of goods sold, the fixed portion, and the variable portion, okay. That will give you your
It said operating expenses
cost of goods sold fixed portion and operating expenses fixed portion. Yeah. Now what happened to the variable portion? Because it's already deducted on the top. Yeah. Okay. So like this slide says, contribution margin income statement. It is or variable costing income statement emphasizes the behavior rather than cost behavior rather than organizational function. And then you have contribution margin. Contribution margin is your sales minus variable cost only. Sales minus variable cost is the amount that remains after all variable costs are subtracted from sales. And this is just a preparation for the next portion that is coming, okay? So remember last time when we started the chapter, we talked about cost volume profit analysis. So it is an examination of relationships amongst cost volume of a profit and the amount of profit, okay? So if you want your income statement, if you want your profit margin to be, or your profit to be a certain point, how much the volume should be, how much the cost should be, all right? Or if you reduce the volume, how much your sales will be, and therefore the effect on your profit. Yeah. So these are different relationships that we are studying. Okay, relationship between cost, volume, and the profits. All right, and it usually applies to a single product, okay, or product line, or a division in a company. Okay, so if you have a mixture of products, you have different lines of products, that's going to be a little bit difficult. That means you probably have to do analysis for each product separately. So this is only common in corporations where you have one line of products. Okay. So if you want to see this in the context of cost volume profit analysis, profit and operating income means the same thing. Profit and operating income. Usually this cost volume profit analysis or cost volume profit expression is expressed in this formula: sales revenues minus variable cost minus fixed costs. I mean, it's equal profit. Your total sales minus all costs, the fixed and the variable, and that gives you profit. Okay, so that's where if you take a look over here, so this is your profit, and these are your costs, and these are your volume. Okay, so if you increase your sales, what happened to the profit? If you reduce variable cost or increase fixed cost, what is the effect on profit? This is the kind of analysis or the kind of relationships, okay, amongst these items: the cost, the sales, the cost, and the profit. Or you could say your sales are your sales units times sale price per unit, okay, plus variable rate per unit. Minus variable rate per unit minus fixed cost. So if you sell like 200 pikes, $25 a pike, so your sales are equal how many pikes times 25 or 28 minus, let's say the variable cost per pike is $15 times how many you sold minus fixed costs. That will give you profit. So generally speaking, your profit is your sales minus your costs, and the costs are variable and fixed. Yeah. So you could do it as a total, or you could do it on a per unit basis. Yeah. Okay. Now break even analysis that you might ask yourself a questions, if you start a project or you start a new.
That means you don't make no profit and you don't have a loss either, right?
How many units you have to sell until you break even? That's, you might ask yourself this question. How many units you have to sell to break even?
So we don't have a loss.
That means you cover all your costs and then you start making profits, yeah. It doesn't mean that you are not selling, but you are selling and selling and selling, but you are still recovering your costs until you recover all the costs, and from that point and above is you're going to profit going to your pocket, yeah. That means the capital that you invested in, you have returned it, yeah. So that's in generally speaking. And then what is margin of safety? If you have margin of safety, that means you have a cushion. Okay, if you experience a loss, you find because you have a cushion to fall on, you have some profit to fall on, yeah, and that's your margin of safety. Like I always give an example. If you want to dazzle in stocks, okay, you don't make too much profits if you spend your life in order to make money. You have to buy a big volume. You're going to have to buy 50, 100 shares if you want to make money. But if you start gradually, that might be fine. You start buying maybe a couple of shares, and then in a couple of months you buy another few shares, 3, 4 shares, and over a couple of years you probably have built a portfolio of shares of stocks. Because remember the projects in the finance? No, you haven't taken finance yet. Yeah, they have to do a project where you have to buy shares of stocks. Yeah, and you monitor the prices for the whole semester. Yeah, and yeah. But some previous students told me they took that experience with them, and now they have a portfolio, and they have worth like $17,000-$20,000. Someone told me worth of stocks, and they all keep in touch with each other, and they call each other when there is a time to buy and time to sell. They keep but if you
make a group,
yeah.
and they
Yeah.
can get money like that.
And, but that's you can do it gradually. But if you want to make profit overnight, you have to have a big chunk of,
You gotta have a big
and you
lot.
got to also afford to lose. So, but you cannot use your life savings.
Yeah,
I always say, don't use your life savings to go and buy shares of stocks.
It's like
That means you don't have a cushion to fall on. You don't have margin of safety.
Don't fall on
Yeah.
your face.
So yeah, it's okay. Buy 1 or 2 at a time, 1 or 2, until you build your portfolio. At that time, when you have a volume, then you can afford to buy and sell. Okay. So okay, that's margin of safety. The number of sales units or amount of sales dollars by which actual sales can fall below planned sales without resulting in a loss, because you have cushion. Yes. Now the contribution margin, like we said, is your sales minus your variable cost. That gives you your contribution margin before you deduct the fixed cost. Okay. A profit is what remains after fixed costs are paid and subtracted from the contribution margin. So just contribution margin alone does not indicate that you have profit yet, until you take off the other portion of cost, which is the fixed cost. So contribution margin minus fixed cost gives you the profit. The contribution margin is your sales minus variable cost. Yeah. So the break-even point, the point at which the profit is equal to 0, your sales minus contribution margin equals 0, or sales minus variable costs minus fixed cost equals 0. That's the contribution margin, that's the break-even, okay, formula. So the break-even formula can be expressed as the point at which contribution margin minus total fixed cost equal 0. So in terms of a formula, your break-even point is fixed costs divided by contribution margin per unit, which is sales price minus variable cost. Okay? Or if you want to do it in terms of dollars, not in terms of units, like you say, all right, I want to sell up to specific dollars when I break even, it's going to be your break even, your selling price times break even units. So if you break even in terms of units, let's say I break even when I do 100,000 units, but in terms of dollars, you just multiply that by sales price per unit. That will give you contribution margin per dollar. In terms of dollars, yeah. So contribution margin ratio is equal to contribution margin divided by selling price. Break even in dollars is your fixed cost divided by contribution margin ratio. Okay. This we will do hopefully some practice, maybe tomorrow, a little bit of practice. What happens in when you have a multi-products? Okay, remember earlier we said that is most widely used with one line of product, this kind of analysis. Most companies sell a variety of products or services that often have different variable and fixed costs and different selling prices. So you have what you call a sales mix. In this case, sales mix is the proportion of each product's unit sales relative to the company's total unit sales. So if your total sales are 1,000 units and you have 1, 2, 3, 4 products, so each sales mix is going to be the portion of that portion out of the total. Second product is that portion out of the total, yeah. So if a website company sells 500 units, of which 300 units are standard and 200 units are express, the sales mix is 3:2. So you add the okay. So 300 out of the 500 and 200 out of the 500.
40%.
Huh?
60%.
The percentage is 3:2.
Yeah, like 60-40.
I think I'm going to let me stop. And I'm not going to hold you for the multi-product. Just do the easy one, yeah. Okay, just if you know the definition, you'll be fine. Yeah? Using cost volume profit analysis to plan future sales, and that's what it's used for. You know, if you do a business plan, okay, and you can use this analysis, it's very, very helpful as part of your business plan, especially when you forecast your sales. You ask yourself, how should I, when will I start making profit? Yeah, you know, and so this kind of analysis is really good for that purpose. So for planning, managers can use CVP analysis to calculate net income when sales volume is known, or they can determine the level of sales needed to reach a target. Yeah, also if you want, you can use, there is also another formula. If you want your profit to be such and such, so how many units you need to sell? If your profit, and let me see if they had that yet here. Let me. That would be on page. Let me see if you have a target profit. I forgot the formula for that. Oh, here it is. Your fixed costs plus your profit divided by your contribution margin. So if you say, if I want my profits to be $20,000, so you take your fixed cost plus $20,000 divided by your contribution margin. Okay, it's the same formula for break even. You just add your target profit. On page 937, you will see it on page 937. You see that? Okay. Well, that's it. And the balance of time, please. I need assignments, and I need to go and give you exam 2.
You got a stapler, Doc?
Yeah.
I got 14, 15, 16 right here.
You have those?
Mm-hmm.
You need to go log on and enter them in.
14, 15,
Uh-huh.
and 16.
Okay. I'll, just go online and
Okay.
submit your exam,
Yes, sir.
or your assignment, sorry. And I'm going to see if I can give you guys the final exam. And it's going to be due 26 is the last day. Yeah.
I'm leaving.
So let me go and get you the final exam.
Yep, I got the blue line done. I got this one done.
Let me stop.